what are my options if my long-term care policy becomes too expensive with the recurring premium increases?
We've been getting this a lot
Yeah.
because we have a lot of clients that bought long-term care insurance policies a long time ago, and they were selling those policies like hotcakes to a group, of 40 to 60-year olds, I'd say, that
Hmm.
wasn't going to be using it for quite a while.
Yeah.
And now all of a sudden they got those groups, over the last 20 years that are now 60 to 80. And that's starting to be a situation where more and more of them are, using those
Hmm.
policies.
Yeah.
And these companies are waking up. And, long-term care is probably a growth industry, partly because they're the things that can cause sudden death, like strokes and heart attacks and even cancer, which isn't sudden but can be shortish, right?
Hmm.
Are they're getting better and better at those, and so they're basically making it so that people are now, instead of dying from a heart attack, possibly ending up in long-term care
Yeah.
and maybe even in memory care, which is the fastest growing area. It's all expensive, yeah.
Yeah.
And these policies have caps, and they know how much they're going to pay out. It's just how many people are now being paid
Hmm.
out versus maybe what they thought. So they're trying to stay in business, and they're doing that by basically moving the premiums up.
Yeah. And so basically, what these insurance they go to whatever state board. So for California, they go to the California Insurance Board and basically say, "Hey, we want to raise the rates for this class of long-term care policies." So they're not raising on individual people, but they're raising on kind of that class, so everyone that's in the same likeness or the same group. And they're saying they can ask for whatever they want. They could say we want to increase it 100%, but California's insurance board will approve whatever amount, and once they approve it, essentially before the rate goes into effect, the long-term care policy, they have to do it within 60 days. Provide or before 60 days, they have to provide written notice of it before it goes into effect. And so, what are your options when you kind of get this letter and you realize the premiums are too expensive? So California says, um, if you just can't pay any premiums, they have to offer you kind of like a paid up policy where you'll have some sort of benefit. It's pretty limited. It's based on how much insurance premiums you paid in, but you don't have to pay any more, but you're not going to get any more increase in your coverage, essentially.
Yeah, so that option, zero premium going forward,
Yeah.
right? Limit your coverage less than you've got, but basically they're just giving you credit for what you already paid,
Hmm.
which is great. So they're not just like, hey, it's going to be 100% higher, and if you don't want that, you're out,
Yeah.
right? You do have an option often to just be able to keep it and not have any premiums, and at least have some coverage.
Yeah, and so they have to work with you to kind of figure out, how do you keep this policy? Is your current premiums, within your budget, right? Let's say they are. Can we change how your policy is structured so that we can still, as a company, afford it, but maybe you can still have pre insurance, and so that could be whether, so there's kind of some variables you have your benefit period, your daily benefit, your kind of your inflation protection, and so they can start to reduce these and change these little factors to kind of get to a policy where they can quote you at the same premium.
Yeah, so for example, if you're $6,000 a year and they come to you and say, "Hey, it's going to be 10,000 for that now,"
Yeah.
or whatever, and so you say, "Well, I could afford the six. I've been paying the six." And so you go to the insurance company and say, "What can I get for six?" That's
Yeah.
basically what it comes down to. And so they manipulate different pieces of it, because they know all the actuarial stuff behind the scenes, and maybe they're getting rid of your cost of living increase that you've got on the benefit or whatever. There's a whole bunch of
Yeah,
little
you could be
pieces.
like, hey, I have a 5% inflation
Right,
premium. We'll lower to like 2%
right,
instead, and
right.
so it's cheaper for the the insurance company in the long term because they just don't have to keep ratcheting up your benefit.
Yeah, it reduces their future liability, which is what they're looking at. So, yeah, I think it's kind of interesting how this is working, and this is a good question actually, because we're getting a lot of concern from clients. They're getting these big notices, and Some of them aren't, that great at describing what you can do.
Yeah.
And almost every single time that we've dealt with a client, get on the phone with a company or what have you, it's worked out pretty well. Clients
Yeah.
seem to be
And so,
satisfied. Yeah.
these companies, they're trying to send you an advance notice so you have time to kind of make these adjustments.
Yeah.
And so you can work with your, whoever's your broker or your advisor, and then you can kind of use these conference calls and just ask questions. What are my options available to me? What's the paid up option? What's the reduced benefit option? What can I change to kind of maintain these policies?
Yeah, yeah, I think it's a great subject. I'm telling you, if you haven't gotten a notice yet on your long-term care insurance policy,
You're likely to.
you're likely to. It seems like we're getting almost every client that has one has been getting some kind of notice. So
Yeah, and the point of these policies are to kind of protect your partner in a sense. You don't want to, if one of you went into long-term care, you don't want your asset base to basically be depleted, and your partner still have to live on a depleted asset base.
yeah, exactly.